What's up, apes? Hope everybody is having a fantastic day out there, but I know that your day hasn't been as good as the WSO Alpha portfolios. Our portfolio through the roof today, absolutely ripping, couldn't believe it. It was up a whole 1.02 basis points or 102 bips for those finance nerds out there. Completely dominated the NASDAQ's 95 basis point return on the day. Literally embarrassing. Like, I couldn't even show up to work the next day if those were my returns. The S&P, we didn't even have to talk about because it was up less than 70 basis points for the session, so I don't get out of bed for anything under 80 bips. Everybody knows that. Now, it was a particularly good session because names like Tesla and Autodesk performed hella strong on Monday here. Tesla was because Elon is sticking around as CEO because he got his $56 billion pay package. Hard to believe that paying a CEO $56 billion is a reason for a stock to go up, but crazier things have happened. And I mean, Billy Joel said it. We didn't start the fire, but we tried to fight it, and instead we just got stock market returns, which I think all of us will take. Now, Autodesk, on the other hand, this one was a little bit shakier. I'm going to provide more detail on that in the banana bits in just a quick second for everybody. But before we get into that, let's talk about some of the other banana bits for the day. Who knew that a 7% addition to corporate taxes could cause such drama? I guess I should have known, because any addition of taxes, I mean, they tried to charge us 2% tax on whiskey and we started a fucking revolution for it here in the US. Fuck Great Britain, by the way. But basically, the Biden administration is considering raising taxes from the 21% to 28% at the corporate level as a final act so that he can try to buy more votes from the left prior to the election coming up in November of this year. So it's starting a big fight. There's $1 billion at stake, $1 trillion at stake, excuse me. So check out that WSJ article if you can. Autodesk, meanwhile, the stock was ripping today because in the morning, it was announced that an activist investor held a position. During the day, rumors kind of emerged as they might actually be suing Autodesk for basically failure to comply with certain disclosure rules and filing a delayed disclosure, whatever. And so after hours, they did end up suing them. So the numbers could be very different tomorrow, but we will take that dub here today. Meanwhile, consumer spending expectations back on the rise, and we'll talk about why in just a quick second, has a lot to do with our macro story of the day with loosening policy without actually loosening policy. And finally, market concentration is way worse in other countries than it is in the United States. That's kind of true of most things. Like, if you think of something that's bad in the United States, it's probably worse elsewhere. So shout out to all of the international apes out there. Sorry if I just absolutely roasted you. By the way, speaking of other reasons why the United States is absolutely the best, check out my desk right here. The Boston Celtics play in the United States. What more reason do you need? Plus, the boy Abraham Lincoln has been cooking since like 1815 or whenever the hell he was born. Either way, let's go ahead and get into the macro monkey story of the day. And now that we're talking about the United States, and that's because the United States Central Bank is effectively loosening policy without actually loosening policy right now. That's the situation that we're in, and it's the picture that 𝗟𝗡 painted for us last week at the FOMC meeting. So what are we talking about? Basically, we all know the Federal Reserve as the interest rate setting arm of the US government. They're in charge of controlling the speed or velocity of the money flow throughout the economy. So when we're lowering interest rates, we call that loosening policy, because effectively what you're doing when you're lowering interest rates is decreasing the cost of money, and that makes it a lot easier to move around. It's less valuable to the person holding it right at that second, so that it's easier to give up, and it adds liquidity into the system at the end of the day. So in order to loosen interest rates or loosen monetary policy more broadly, there's a lot of things you can do. You can lower rates, you can slow balance sheet runoffs or grow the balance sheet once again. Those are what we call hard monetary policy. Soft monetary policy, on the other hand, is just as effective. And one of the most effective tools in soft monetary policy is all about setting interest rate expectations. Now, it's something that we talk about quite a lot here at the Daily Peel. And if you look at this chart, we can still see that the expectation for the end of the year is for about 2 basis point cuts. Not 2 basis points, 2 cuts of 25 basis points, excuse me. Now, I think the most accurate statement you could make about consensus rate expectations right now is that the market is looking for at least 1 cut. Not necessarily expecting 2 cuts, but they're saying we'll at least get 1 right now. Personally, my opinion is that we're either going to get 0 or we're going to get 2, because 𝗟𝗡 is a man of commitment. When he does something, he goes big with it. So I expect 2 cuts at the end of the year, which means that I think this is correct. But if we go ahead and take a look back at the dot plot that the FOMC released with the summary of economic projections accompanying the meeting last week, what we can see is basically this. This is a chart from Barron's breaking down the FOMC participants and their expectations for interest rates for the end of 2024. We see a very slight dotted declining line right here going to about 5.1%. So that would imply that they're expecting a range of 5 to 5.25%, but markets might be a little bit more aggressive on the cutting side of things. And we can understand why, because we can already see those cuts in effect with the US 10-year. So what are we talking about here? Soft monetary policy is all about expectation. So Jerome Powell last week, when he got on stage, he said, we're not cutting interest rates right now. And then he went into this whole diatribe about exactly why. It's that diatribe that is important for us today, because he basically laid out exactly what conditions it would take for the Fed to start cutting rates. And effectively, it boils down to one thing: slower inflation. So Powell gave the market kind of a bit of a wink there. Like he said, we're not cutting rates right now, which to any casual viewer would sound like, okay, so the Fed doesn't want to cut rates at any point soon. But anybody who actually read or listened to him drone on and on for hours, looking as handsome as he always does, you would have realized that he's basically saying, like, we're just waiting for inflation to get closer to the 2% mark. Now, if you go on Twitter, if you ask just about anybody, the big disagreement here among market participants is about the inflation rate. Because if we look at CPI, we're looking at most of it, or the single largest component is something called owner's equivalent rent. It's an absolutely terrible way to measure the cost of shelter inflation. Effectively, what they do is they call up on literal landline phones. So these are the boomer of boomers that they're calling and saying, like, hey, how much would you rent out your guest room for? That's effectively what they're doing to determine shelter inflation. But if we look at an actual rental tracker from Redfin, we can see that it's quite a different story. So the owner's equivalent rent, what they use in CPI, is suggesting about 5.1% shelter inflation right now. Meanwhile, the rental tracker is suggesting minus 0.8%, aka 0.8% worth of deflation in shelter costs. So if that was the case, then we would actually be below 2% inflation right now. The Fed doesn't do that because the US government doesn't use any methodologies that were devised after World War II. So we're kind of stuck with what we got right now, and that's the situation that Powell is creating. But nonetheless, kind of recognizing the issue as it's becoming, or at least a willingness to lower interest rates before getting to what he says it is. This is exactly how you formulate that. So you come out and you say things like, we're going to lower rates when inflation is lower. The market thinks, okay, inflation has been lowering. It's probably going to continue to lower, especially because of that shelter stuff. Rates are going down before the end of this year. We gotta buy up the 10-year. So that's effectively what happened right here. That's why you see yields completely plummeting. The 10-year yield is basically the underlying yield for almost every loan in the United States. If you get a mortgage, auto loan, credit card, or a credit card to pay off your other credit card, the rate is probably going to be built upon the 10-year yield, and then they'll add in certain things like risk and all that other bullshit to make you pay more money effectively. And so what we're seeing with the 10-year note already falling is an effective loosening of monetary policy. It's not at the Federal Reserve level, but it's at the Treasury level. It's kind of one step above. If the central bank is like the core, this is like the slightly outer core. So it's not too different, but the Fed is effectively loosening without loosening policy right now. Once again, it's that wink, wink, message received, quiet and clear. Let's go ahead and move on into some of the big stock movers of the day. First and foremost, we have Palantir. So this stock was up 6.1% on the day for no fucking reason. Ben Graham would throw up, and so would 𝗪𝗏𝗪𝗏, who is the founder of a company called Argus Research. An Argus Research analyst came out yesterday and were hyping up Palantir like nobody's business. They were saying that the stock is still a buy despite its tremendous valuation. When I say tremendous, I mean high, not good, by the way. It's fucking terrible valuation. But the stock was up 6.1% because these analysts are saying that the AI wave is going to be enough to basically grow into that valuation. So they slapped on a $29 price target, 23% from Friday's close. Really nothing too aggressive, but any kind of upgrades like that are always going to get the market excited. Meanwhile, Best Buy got an upgrade as well. This one was from UBS to piece of shit companies, if you ask me, working together to drive returns. For one of them, the stock was up 4.6% on the day because UBS basically said, they're doing well in their inventory management side of things. They expect a big upgrade cycle for consumers in the electronic space, and Best Buy is apparently coming out with some new products that they're going to be selling that the market is pretty hot on. So we'll see if that actually works out. UBS slapped a $106 per share price target, implying a 21.5% from Friday's close. Anyway, let's go on back down to our corporate incel, Virgin Galactic, ticker symbol SPCE, down 14.6% on the day. Have you ever seen anything more beautiful? This company, scumbag Richard Branson, just trying to stay afloat, quite honestly. Basically what happened is Virgin Galactic did a 20-for-1 reverse stock split. This means that if you held 20 shares of Virgin Galactic on Friday, you now hold 1 share, and the price is 20 times what it was on Friday. It's the exact opposite of a stock split. So the reason that they did that was because their stock was trading below $1. And if you're on the New York Stock Exchange, you cannot trade below $1 in terms of share price for longer than 30 days and stay listed. So in order to avoid that delisting problem, Virgin Galactic enacted this reverse stock split. They didn't decide like, hey, maybe we should make more money or cut costs or anything. No, they said, let's go ahead and just fuck around with our cap table. So that's exactly what they did. And the market obviously smelled their clear bullshit attempt. It's not 2021 anymore where this would have flown under the radar, probably gone up 65%, 69%. What am I saying? These are meme traders we're talking about, maybe even 420%. But either way, the stock was down 14.6%. Post-split, it opened at $14.80, and it just completely fell apart from that point going forward. Bullshit attempt to stay afloat. I mean, it was basically as valid as, you know, like this whole space tourism thing. It basically panned out in the same exact manner as NFTs, but less fiery explosion, ironically enough, even though it is space tourism, and Virgin Galactic is really good at blowing up ships. Meanwhile, GameStop was down 12.1% on the session. Wasn't really any news. Keith Gill didn't, you know, tweet a picture of him taking a shit or anything to send the stock up 50%. So the stock fell 12.1% because there's no actual value behind this company. So without people pumping it constantly day in and day out, it is going to sink like a rock. However, I do have to say a big thank you to Mr. Keith Gill, Deep fucking Value, Roaring Kitty, whatever he prefers to go by, because he apparently listens to the Daily Peel. So we had been begging and pleading with this guy to pull out $5-10 million for quite some time just to make sure that he doesn't completely fuck over his family in this whole GameStop saga. Like, brother, you had like upwards of $500 million and you left some of it on the table. Like, I can't even imagine what the mental process is to say, no, I don't want to support my family and make sure my children never have to work again. I'm going balls deep in GameStop. Whatever. Teach their own. This is America. Do what you want with your money. But thankfully, he did pull $6.3 million out of the stock and set it aside as liquid cash. So hopefully he holds on to that and doesn't just reinvest. He basically closed out his option position, bought, I think, 9 million more shares of GameStop. So he still holds an absolute fuck ton of it, but he doesn't have that June 20th expiration date coming up to haunt him anymore. So shout out to GameStop and the entire Gill family, who are now $6.3 million richer. Good for you guys. Hopefully nobody breaks into your house and tries to log into your E-Trade account or anything. Anyway, S&P 500 forecast. We got to make this make sense because banks, I think, are a little bit lost. I mean, we know banks aren't too good at math. Everybody knows that. And we got to talk about exactly what's going on with these projections right here. So banks, they do S&P 500 price targets for the end of the following year. Like, they do this constantly all the time. I mean, we all know that banks have thrown price targets out on literally everything. And so at the end of 2023, the median expectation for the end of 2024 S&P 500 price target was 4,875. Now, we are starting to get some mid-year updates. This is where these banks come out and they don't say, okay, this is what we got wrong and here's how we're going to improve our outlook for the rest of the year. They just say, pretend we didn't say that 6 months ago. This is what we're saying right now. The past is the past. Who cares? We're all about going forward. And now the expected median year-end price target for the S&P 500 is 5,225. So it sounds like a bit more optimistic, but when we take a step back, at the end of 2023, the median expectation then of 4,875 implied roughly a 2.2% return. So basically a flat year in the S&P 500 in 2024. Now, if we look at this mid-year update, compared to where we are right now, going to a level of 5,225 implies a loss of 3.8%, which would still be an up year. Even if we did lose that much, would be up like 6 or 7% for the year. But it's still like, what the hell are you talking about? Like, what is going on right now? So if we take the median expectation and compare it to where the S&P 500 was at the end of 2023, up with the new median expectation for that 5,225, we are expecting a 9.5% return, which is exactly the average. I mean, that is literally just the definition of an average year in the S&P 500. Since 1929, the average annual returns, not total returns, just the stock prices themselves, is 7.9%. We add in a dividend yield of about 2%, we get to somewhere around 9.5-10%. So markets are effectively expecting an average year from this point forward, but they're also suggesting that we are going to be declining going into the end of the year. And if we look at this table, it actually shows those year-end price targets. We can see that a lot of banks like JP Morgan, Morgan Stanley, Cantor Fitzgerald, Evercore, Citigroup, Deutsche have not updated their price targets for the year. The highest price target right now is BMO at 5,600. That's Brian Belsky for you, the ultimate bull besides maybe Tom Lee. Now, if we kind of take a step back and realize what a 9.5% projection means in the grand scheme of things, well, this is basically your answer. I hope you can see the scatter plot. This is showing the historic returns since 1929. We got about 100 dots on the screen. And these two bars that I'm showing right here show roughly the average. And if we look at this, we can see that there are only 8 years that fit within this average line in the entire history of the S&P 500. So although that is our average, very rarely do we actually see that. In fact, when we're talking about the number of average years that we've seen, we've actually seen the same number of years that were above a 30% return and below a 17.8% loss. So we're talking about averages here. I mean, it never actually returns the average, but I guess that's what Wall Street is pricing for right now. We're basically already at that average return for 2024 so far. So in order to expect that, they would have to be saying that the rest of the year is going to be flat or lower. They are saying that the rest of the year is going to be lower, but it doesn't really make a whole lot of sense considering that economic data is still holding up relatively strong. Inflation has been on the decline, and that's basically been the whole kit and caboodle. Plus, the only reason that I can think that would possibly make sense is that instead of expecting 6 or 7 rate cuts like we did at the end of 2023, we're only expecting 1 to 2 rate cuts right now, but we're still expecting the index to be higher than we were at the end of 2023. It's a whole lot of nonsense. Definitely let us know what you think about this and what drugs you think these banks are smoking. But of course, we have to finish up with a quote about forecasting from the man who hates forecasters more than anybody else, Mr. Nassim Taleb. And he once said, these people, talking about forecasters, don't really have skin in the game. They just need to tell a good story. Well, we would love to be able to do either one, to be able to forecast or tell a good story, but we are just out here yapping, and we're going to continue to do it going forward. Nassim Taleb, by the way, wrote a fantastic series of books for anybody who cares about risk management. It's called the 𝗪𝗀𝗄 series. I couldn't recommend it enough. Skin in the Game, the most recent one, and the shortest one, by the way, is my personal favorite, so definitely go ahead and check all that stuff out. It is now 7:50 p.m. I cannot wait to watch the Boston Celtics absolutely embarrass Luka Doncic, most of all Kyrie Irving, and especially Mark Cuban at home in Boston at the TD Garden and raise their 18th banner here tonight. Very excited to see it. I'm praying to our Lord and Savior Kevin Garnett that he lets it go through. We'll see what happens. For now, apes, I'll talk to you guys tomorrow. Happy investing, happy trading. Bye now.